Strategist of Invesco Asia Pacific. Hi, David. Good morning and great to be speaking with you. Firstly, help us with your reading onto the Fed's outcome, because Donald Trump has been coming out with a big ask now, with a 2.5% rate cut is what he's suggesting for Fed to take action on. But the Fed has come out with a verdict, no change this time. Give us your sense that how do you read this rate cut for now and the implications going ahead?
Good morning. Well, there was certainly no surprise that came out of the FOMC meeting that we just had. And the Fed's characterization of the U.S. economy remains roughly what it had just 6 weeks ago, that the U.S. economy is sound, but the concerns are still what the tariffs may bring. We know back in 2018, during the first tariff war, that we didn't really see any price level or any kind of inflationary impacts from the tariffs. And that was because companies absorbed many of the tariffs instead of raising prices, but they also laid off some of their employees. So the big question this time around, as the tariffs continue to work their way through the system, is, are consumers going to bear the brunt of it, or will the suppliers and the stores do so?
David, what I'm intrigued about is what's happening with world markets as a reaction to what's going on in West Asia. They're completely shunning and ignoring all that's happening. I mean, the only market which is most sensitive right now is crude, and rightfully so, but not equities.
Well, I think that the equity market has retraced a lot of what it's lost since the Liberation Day, and it reflects a continued risk on sentiment. Now, the bond markets are a lot more wary of both the fiscal situation in the U.S. and also the potential stagflationary winds that the U.S. economy is facing. But we have just come out with our mid-year outlook, and we're calling for diversification. We think that investors are overly exposed, overly concentrated in certain assets like the U.S. equity market or even U.S. dollar, and we think that there are brighter opportunities that currently exist, namely in European equities or in Asian credit.
Interesting you say that. Would you want to detail that? Where within Europe do you find opportunities, and of course Asia as well?
Well, I think in Europe, we continue to have greater fiscal stimulus in places like Germany, the UK, and also monetary stimulus. The ECB has recently cut rates. This further liquidity should boost the equity market. The defense spending addition that Germany has announced is likely to flow down to factories and materials, construction, infrastructure. So we broadly like European equities at these levels. In Asia, the only times that emerging markets have outperformed developed markets over the past 10, 15 years has been when the US dollar is weakening, local central banks are cutting rates, and oil is below $80 a barrel. So it makes a good case for investors to stay invested in India. I think the big question is if this Middle East conflict spreads to a wider regional conflagration, and then oil goes above $80, that could certainly upset the the apple cart for Indian equities and for Asian equities.
But David, when you talk about diversification, is it also about diversifying into other asset classes? I mean, is it just a regional call, or is it also an asset class call?
I think it means diversifying away from being overly concentrated. And we know that investors, foreign investors have been overly concentrated, especially in US equities. If you look at the market cap concentration that US stocks have for MSCI Global Index, it's around 70–80%. The US economy is only around 20% of global economics. Of the global economy. So I think that reducing concentration, looking at other places makes sense. I'm not saying investors should be selling the US or that US assets are becoming less attractive. I just think that a broader diversification in one's asset allocation is a prudent measure, especially during these times of uncertainty.
Well, yes, uncertain times indeed, David. But when we look at some of the big cues, then yes, Iran-Israel conflict, that story is developing. The big event with Fed, that is over now. But the upcoming event, David, is the tariff deadline maybe, which we are approaching 9th of July. That's the big event that the world is eyeing. Give us some sense that as we approach towards this date, do you believe that the markets can once again get jittery, or the investors have digested that the worst is behind with respect to tariffs?
I think investors are a little too sanguine regarding the tariffs. I don't think that we're out of the woods yet for the tariffs. I think that we were supposed to get a deal announced every single day during these 90-day reprieves. We only got 3. It's unlikely that most countries will be able to sign deals before the deadline next month, and that could mean more negative tariff headlines. But ultimately, I just want to remind everyone that tariffs are a near-term overhang, that we're likely to move through this overhang later on in this year. And then that's when investors will start to focus on fundamentals, on growth, on corporate earnings. And I think that there are many bright spots where that's happening, whether if it's in China AI or Indian equities or European defense companies or Asian credit, there are bright opportunities to be had.
Interesting. David, good to get in your insights. Glad that you could take time out and join in today.
Thank you so much.
Okay, that's a flavor of what's happening around the world, but what's happening in India? It's continuing to get extremely range-bound and extremely stock-specific as well. And yeah, it's a sectoral churn which continues to